The U.S. economy is standing at a crossroads right now, and the decision of a small group of people at the Federal Reserve could shape your financial life for years. Whether you're trying to buy a home, pay off debt, start a business, or simply keep up with rising prices, the power the Fed holds over interest rates affects you more than almost anything else happening in the world. And here's the wild part. Most people have no idea how it actually works. What if I told you that one decision from the Fed could make your rent go up, your loans get more expensive, and the stock market fall? Or that a different decision could make borrowing cheaper, boost jobs, and help bring prices under control?
Hey, real quick, before we jump into the video, please take some time to read the full disclaimer on the screen.
Today, we're breaking down exactly how the Federal Reserve can save the U.S. economy and why interest rates are the most important and most misunderstood lever they control. And trust me, once you understand this, you'll start seeing every economic headline in a totally different way. Before we go deeper, here's the most important thing to know. Interest rates act like the economy's accelerator and brake pedal. Push one way, the whole country speeds up. Push the other way, everything slows down. When the Fed raises interest rates, it becomes more expensive to borrow money. Mortgages? More expensive. Car loans? More expensive. Credit cards? Definitely more expensive. Business loans? Harder to get. Suddenly, people aren't buying as much, companies aren't hiring as much, and the economy cools down. That sounds bad at first, but high inflation is even worse. When prices rise too fast, people can't keep up. The Fed raises rates to control that. But here's the risk. If they raise rates too much, the economy doesn't just cool, it freezes. Companies lay off workers. Spending drops. Recession begins. Now go the opposite direction. When the Fed lowers interest rates, borrowing becomes cheap. Families can afford mortgages again. Businesses expand and hire more workers. Consumers spend more. The stock market usually climbs because investors see growth coming. It's like hitting the boost button. So the big question is, what should the Fed be doing right now? Raise rates? Lower them? Hold steady? Right now, the Fed is facing one of the most delicate moments in modern history. Inflation has slowed, but it's still higher than people want. The housing market is stressed. Businesses are cautious. Consumers are stretched thin. A wrong decision could push the country into recession or reignite inflation. Which brings us to the challenge. The Fed has to balance these two forces without letting either one get out of control. They're trying to lower inflation without crushing growth. Typing that sounds easier than doing it. Here's something most people don't know. The Fed's changes to interest rates don't hit the economy immediately. They take months, sometimes a full year to be fully felt. Imagine steering a giant ship. When you turn the wheel, nothing happens at first. Only after a long delay does the ship start changing direction. That's the Fed's reality. This means that the decisions they make today are aimed at problems that might appear months from now. They're always trying to predict the future, and predictions are never perfect. So let's break it down simply. If the Fed wants to save the economy, they need to slowly and carefully lower interest rates. Not too fast, because that risks sending inflation right back up. Not too slow, because that risks tipping the economy into a downturn. They need what economists call a soft landing, where inflation falls without the economy crashing. Pulling this off is like trying to land a plane on a runway covered in ice. Here's a question for you. Do you think the Fed should start lowering interest rates now, or wait longer? Tell me in the comments. I want to see your reasoning. Let's talk about how interest rates actually affect your daily life, because this is where it gets real. When interest rates rise, your mortgage payment jumps, your credit card debt grows faster, your car loan becomes more expensive, your small business loan becomes harder to get. Your job might even be at risk if your employer cuts back. But when interest rates fall, your loans get easier to manage. More people buy homes, which boosts construction, real estate, furniture sales, and local jobs. More businesses expand. Consumers feel confident and spend more. The whole economy feels lighter. So lowering rates at the right time can breathe new life into the system. But here's a thought-provoking question. Do high interest rates affect you more, or does inflation affect you more? Is it grocery bills, rent, loan payments? Drop your answer in the comments. Everyone experiences this differently. And while you're thinking about that, if this explanation is helping you understand the economy better, make sure to like this video, hit the subscribe button, and share it if you want more content that breaks down complicated topics into simple language. Now let's talk about what happens if the Fed gets things wrong. And this is where it gets scary. If they cut interest rates too quickly, inflation could spike again. Prices could rise even faster than before. People might feel short-term relief, only to get hit with higher costs shortly after. If they wait too long, the economy could enter a recession. Businesses might cut jobs. Investing slows. Spending falls. The stock market suffers. People postpone buying homes or cars. This is the tightrope the Fed is walking. One wrong move and millions of people feel the consequences. But the Fed isn't guessing blindly. They watch key signals like job growth, wage growth, housing activity, and inflation data. They're looking for a moment where the economy shows it's cooling just enough, without collapsing. That's when they can confidently lower rates. Here's another question I want to ask you. Do you trust the Fed to make the right decision, or do you think they've already made mistakes? Leave your answer down in the comments. I really want to know what you think. Now let's imagine the ideal scenario. The Fed begins lowering rates slowly. The housing market becomes more affordable. Companies start investing again. Job growth stabilizes. Consumers feel more confident. Inflation keeps cooling. This is what people call saving the economy. Lower rates, done correctly, can spark a chain reaction of good outcomes. Families can buy homes again. Small businesses feel relief. People spend more, boosting the economy. Companies hire more. Confidence returns. The key is balance. Reduce borrowing costs without letting prices spiral upward again. Let me ask you something else. Do you believe lowering interest rates helps everyone, or does it mostly help the wealthy and corporations? This is a real debate in economics. I'd love to see your take in the comments. Before we wrap up, think about this. Every time the Fed announces a rate decision, the world reacts instantly. Markets swing, analysts panic, news cycles explode. But behind all that noise, the real impact hits regular people, home buyers, renters, borrowers, workers, and families. Interest rates may seem like a dry topic, but they affect your life more than almost any policy you'll ever hear about. So now that you understand how the Fed uses interest rates, here's the final big question. If you were in charge of the Fed right now, what would you do? Lower rates? Keep them high? Something else? Drop your answer in the comments. I'll be reading them. And if this video helped you understand how the Fed can save the economy, make sure to like the video, subscribe to the channel, and share it with someone who wants simple explanations of big economic topics. Thanks for watching, and I'll see you in the next one.